Hi, everybody. Welcome to August. This is the Monthly Market Insight Live, reflecting on everything that's happened, especially in the month of July. It's been quite a roller coaster as we kind of reflect on last week and how the markets performed. Summer's winding down. Kids are going back to school. I know in my world, we consider August pretty much fall. Football's here. Football started. So we're excited to get into the fall. We're in probably knee deep in third quarter right now, which is heavily weighted on company earnings, which we can kind of see has been reflected in the market, especially last week, that we'll get into. But Sean, kind of what we want to talk about right now is what we've talked about the past couple months, really year to date on these webinars, is there's a lot of information, a lot of conflicting information and data that as investors we're receiving. So, on one side, we have inflation, for the month of June sitting at 9.1, we have talks of recession. And then on the other side, we have, low unemployment sitting at around 3.6. We have, wage growth over 5%. We have jobs reports that have been pretty positive, with another one coming out on Friday. So Sean, help me make sense of all this information. And kind of what we want to start with right here is talk about, stocks and bonds. We've had a lot of questions come about as saying, hey, Sean, I have my, funds, my emergency fund sitting in a pretty conservative portfolio. Why is my portfolio down as much? Can you explain that? We've had a lot of questions around I bonds. So Sean, can you talk to us a little bit about that?
Yeah, so, it's been a very unique market, but not a market we've never seen before. And a lot of what we're going through in these third quarter meetings with clients is hearing some of their concerns and frustrations. So we want to share that information with you. And one of the biggest concerns is really, why is, my accounts that are supposed to be safe, or at least a little bit more secure, why are those going down as well? And if everything's going down, where do I even run to for help? And so we're going to cover some of those things today. And really the reason this market is so unique is because it's the first time we've seen it in the last 50 years. And so we've got the aggregate bond index down to over 10%, and the stocks, if you want to look at the S&P 500, also down over 10%. And so again, not something we've never seen before. It's just been since 1976 this market has presented itself this way. And so we want to kind of go by and show you some of the things. Nora, are you able to see my chart now?
Yes.
All right, awesome. So from 2002 to 2022, some of the things we want to kind of cover is, we went through 9/11, kind of happening, and we see that stocks are going down, but bonds kind of stay normal. So here we've got the S&P 500 in bright red, and then in the pink we've got an aggregate bond index that kind of covers investment grade, which we consider treasuries and kind of high quality bonds that are both short-term, intermediate, and long in the pink. And so you can see as stocks are going down after 9/11, that bonds are going up, because what people traditionally do is they sell their stocks while they're going down because they're scared, and they run to something safe, and those bonds are typically safer. So we see that happening there. The same thing in 2008, we have the housing market crashing. So we see stocks, the S&P 500 going down. We see bonds going up during that time, because again, people are selling the thing that's scary, running the thing that's safe. And so then we get this really good long run in the market. The S&P 500 does really well since 2008, with a couple little blips along the way. And stocks kind of stay relatively flat, or even kind of going negative during that time period. Not a great place to be. Interest rates are really low. That's one of the things that the government did, is they lowered interest rates. Everyone's been buying mortgages for 3.25% for really the last 14 years, and everyone thinks that's what a house should be. And now all of a sudden, mortgages are on the market for 5 or 6%, and it gets a little scary. So we get this crash in 2022 that's been a little bit unique, because really, as Nora mentioned, it's really been driven on a lot of fear. We see businesses, we talk to small business owner clients, they're making lots of money, they're booked out through the end of the year. If you try and get a service person to come to your house and do any type of yard work or repair, or people are spending money, so they're all booked up. So we see lots of people making money. We get wage growth of over 5%, yet the market's down over 20%. And in the middle of June, got down about 25%, even though people continue to spend money and business continue to make money. We have strong earnings reports as well. Some of the things that we see with clients is they're talking about gas prices are really high, inflation is really scary. And then I'll ask them, are you still going to drive down to Hilton Head? Are you still going to pay that $5 a gallon? They're like, oh yeah, I'm still going. And so we see people talk about inflation, talk about that fear, yet people really haven't changed their spending habits. And that's why we're kind of concerned or a little bit, I'd say, surprised by how big the market decline has been. And what's exacerbating this market and why the reason that some of those safe accounts haven't been there is because we get this rising inflation. What the Fed has done is they've raised interest rates. We continue to see that last week. We saw them raise another 0.75 of a percentage point, 75 basis points. So interest rates are rising, which means bond prices fall. And so we've got the stock market falling based off of fear. We have bond prices falling because the Fed's taking action to curb inflation. They're raising interest rates. What that means for kind of normal people is if I own a really, really low interest rate bond, and maybe it was paying me 3%, now the Fed has raised their interest rate, which we call the risk-free rate because it's a very, very unlikely probability that the government defaults on our loan. So we call it the risk-free rate. Now that that's higher, I'm going to sell my low interest rate bond. I'm going to go buy another bond that pays a higher interest. So therefore, that bond price falls as everyone sells those low interest bonds. And so what you see here is for the first time since 1976, that stocks are falling and bonds are also falling. And we'll kind of go into another chart to kind of show how this is even bigger. So here's from the beginning of the year, 2022 through close of business yesterday. Again, red being stocks and the pink being kind of those low interest rate or those high quality interest bonds. So you can see that they're both falling. And here's that 10% line. Right back in June, they both fell below 10%. Again, a very, very unique market. And that's why some of those safe accounts and those safe places that money typically is and has been in the past just hasn't provided as much cushion. Now you'll see, right, stocks got down to almost 25%. Bonds are still at about 12%. So it's still a safer place to be, just not as safe as it's supposed to be, right? So we're in a unique market during that time period. The good news is for our clients, as an example, is the bond funds we have essentially create what we call a bond ladder. And what that means is as some of those short-term and intermediate bonds mature, those fund managers automatically go out and buy new bonds. And when they buy those new bonds, they're buying bonds at a higher interest rate. And the reason we do that and create that bond ladder is because it hedges or kind of eliminates what we call interest rate risk. Because interest rates are changing as they are right now, and they'll probably fall as the government gets inflation under control. We'll see interest rates fall again. So to kind of curb some of that risk, we buy those bonds in the form of that bond ladder to mitigate that risk. But that should kind of help explain a little bit about normally stocks are going down, bonds are going up. Why can I not find a safe place to go? And then you're like, well, maybe I'll run to cash. Well, cash is losing 9% with inflation being 9.1%. So it's like we have all three asset classes that are really unsafe. Where's a safe place to go? And so some of the things that people are seeing in the media and questions we've been seeing with clients is, what are these I bond things all about? And so we're going to talk about what are I bonds and kind of some of the limitations and things to look out for as you read more about them in the media and some of the questions and things that we've been telling clients. So an I bond is a savings bond produced by the government, and it's kind of composed of a couple of different things. And what's unique about these is, as an advisor, I can't go buy them for you. There's no one that can sell them to you. You have to go to the government to do it. You have to go to treasurydirect.gov to buy these. But before you do, right, some of the big things that are happening in the media is they're talking about right now they're paying 9.62%. Okay, so if you can get a guaranteed, right, by the federal government, 9.62% bond, why wouldn't you buy that, right? Some of the questions we've been receiving. If cash is unsafe, bonds are unsafe, stocks have been unsafe, here's this safe asset that people have been talking about. So yes, it pays 9.62% all the way through October of 2022. There is federal income tax on it. There's no state income tax on it. The limitation, though, is you can only buy $10,000 worth of these bonds, right? If you could get a guaranteed 9.62%, right, you'd put in millions of dollars, and this our entire portfolio would be in it, if we could. That's why the government limits you into how much you can buy. So one of the limitations is you have to go through the government to do it, through treasurydirect.gov. And you know the government is not going to be the most efficient in managing the process, but that's one way that you have to do it. And then you're limited to $10,000 per person, right, per social security number to buy these bonds. Okay, so that's some of the limitations. You can keep them for up to 30 years. So really, really good things, but that interest rate will change throughout that 30 years, and we'll cover that. So it's not going to pay you that 9.62% for all that entire time. You have to hold on to them for at least 1 year. And if you sell them before 5 years, then you have to pay it back the last 3 months of interest. Okay, so those are some of the unique things. You can redeem them up to 12. I talked about that. And then you only get federal income tax and not state income tax. Right. So how does this interest rate change? What that's all about? So it's made up of two different interest rates, a fixed rate and an inflation rate. And so because we're in this really high inflation rate period, that's why these bonds are paying so well. And that's why they've become this talking point for the media and, probably at the golf course or the club or wherever you're at there. So the fixed rate is kind of known and that won't change throughout the bond, but the inflation rate will. So there's two rates that are in there and that inflation rate is going to change every 6 months. All right. So you got two different types of interest rates that make up that 9.62%. They change on the first business day of May and the first business day of November is when the inflation rate changed. Again, the fixed rate won't change. So you combine those two rates and that's how you get it. So as an example, how has this been done? How does this kind of look? The fixed rate right now is 0.00%, right? So not a very attractive bond to buy, but the inflation rate semi-annually is 4.81% times 2 gives us that 9.62%. So if you're buying bonds today, these I bonds, your fixed rate is 0%, not a good deal. And then your inflation rate will change every 6 months over the next 30 years. So that's kind of some of the things that people are unsure about how these things work. You have to hold on to it for at least 12 months. So you're going to get some of those changes in that inflation rate, but probably over the near term anyway, it's not going to change too drastically. But just know you're not going to get that 9.62% for the entire 30-year period. Kind of some history. I know it's probably really hard to see, but fixed rates, right, were as high as 1.2% in 2005, and they actually got as high as 3.4% back in, I think it was 93. Don't quote me on that, but you can find that all at treasurydirect.gov. But fixed rates, right, are historically really, really low, is the point I'm trying to drive home here. The inflation rates change a lot. So yes, right now it's 4.81% times 2 because it's paid semi-annually. But you can see it was even negative here in 2015. So these rates will change over that time period, and that's made up of two different parts. And that's how we want you to kind of take a look at these. So if you buy it, it might be good for the next year. It might not be such a good deal in 5, 10, 15 years, but you can sell at that point. You just have to go through treasurydirect.gov to do so. Again, kind of a painful process to go about. So limitations of $10,000. Pay federal taxes, no state taxes, made up of two interest rates, a fixed rate, which is 0.0% right now, and an inflation rate, which changes every 6 months. Those are some of the key points when I drive home about these I bonds, right? We tell people, yeah, go out and give it a shot, right? It's going to be somewhere safer, but maybe a good idea to change them or be able to liquidate them at some point in the future. Again, things that we're seeing from clients about ways to drive home or places that people are running, things that the media is talking about, I bonds. Now you're informed about how those things work for you. Right. So those are kind of some of the things we want to talk about in terms of bonds, stocks, why this market's unique. Where is a safe place to go? What are some of the things you need to be concerned about, looking for? Right. As Nora mentioned, we've got really, really good data coming out about the economy. Friday, we get another jobs report. So we're really interested to see, do we kind of exceed jobs expectations? Wage growth has been high. We're starting to see the market come back. We saw the S&P 500 on June 16th. Reach about 3666. That was the low for the year. And people are all wondering and asking, right, is that the low? Are we not going to see anything there? We just don't know that answer, right? That's not a game that we try to play. We're long-term investors. We don't try and time the market or guess. But the market since June 16th is starting to move in the right direction. We're getting more positive data. The market really liked the Fed raising interest rates because that is a kind of a known data point. As soon as the markets know information, they do a really good job of kind of pricing in what they think it will be. As the markets get uncertain, that's when we start to see a lot of the volatility in those markets. One of the things that we're seeing that's a little bit unique about volatility and things we're watching here in the near term is what's happening with China, right? So China really opened up their economy, if you will, right? They have a zero COVID policy. So right now, one of the things that's driving inflation really high is lack of supply. Right, so a lot of goods are made and shipped from China. If they have the zero COVID policy, we can't keep up with supply. And so that's a concern. So we started to see Beijing and China really open up their economy a little bit, and now they're starting to roll it back again as they're kind of enforcing high COVID restrictions once again. So how will that play out? In addition to that, we've got a Congresswoman Pelosi supposedly potentially taking a trip to Taiwan, maybe hurting some of those relationships. How will those things affect the market here over the next coming months? Time will tell. You know, when we look at what's happening with Russia and Ukraine, Probably not as big of a impact in the market in terms of global trade and things. Still an impact, certainly, but not going to be as big of a player as what's happening between the U.S. and China relationship, because we are so closely tied together in terms of global impact. So some of the things we're watching near term, looking at some of those jobs reports, we've had great earnings reports. Job growth numbers are good. The economy should be ready to take off once we get through this. One of the things that we keep telling people as we meet with them is it's been exhausting, right? I mean, the market really started fluctuating, hit a high on 31 December, another one kind of on November, the middle of November. And so since then, it's been over 8 months, really just kind of getting punched in the gut with kind of bad market news. And so people are just waiting for something good to happen. We might start to be trending in that direction with some of this data coming out and kind of people being confident that the Fed's doing the right thing to curb inflation. So things that we're monitoring inside the portfolio and kind of how we've made adaptations to our clients' portfolios.
Great, Sean, I appreciate it. And that kind of provides a good outlook, at least for the rest of the year, the things that we're monitoring. Sean, one of the questions that did come in is we talk about a lot of small businesses having a great year booked out through the end of the year. We do have some clients, especially those in California where there's a lot of tech companies, and we haven't seen as many IPOs. So Sean, tell us why the NASDAQ, which was made up a majority of tech companies, hasn't performed as well or has done worse than the S&P this year. How does some of the decisions that are going on in government impact specifically tech companies? Yeah,
no, it's a great question. So, when you think about the S&P 500, the Fortune 500 companies, you have a company like a Coca-Cola or a company that's been around for a really, really long time. When they go to borrow money, people are like, yeah, you guys are going to continue to sell Coke across the globe, right? We feel confident you're going to be able to do that. We'll loan you money at this interest rate, right? Because you're very well established. We know what you're going to do. We know kind of what your consistent growth has been, right? No problem for them. If I'm a tech company, say an Uber or some type of new technology company, I've been able to grow really quickly, and I've been able to do that by borrowing money from the bank, right? I go borrow money, I invest in research and development, I go hire new people, I develop a new product, you name it, and I'm able to go out and kind of continue to grow my company. But I had to borrow money in order to do that, or raise money. Well, as that interest rate rises, that risk-free rate rises, banks are going to now start to say, you know what, we need to charge you more interest. Or you're going to go to your investors and say, hey, we need more money. They're going to say, I need a higher return because of inflation, because the risk-free rate is higher. So it costs them more money to borrow money. And so that cost of borrowing money is one of the things that's really, really hurt them, is because now people are like, well, we expected you to grow at X rate, but now that it costs you more to borrow money, that's going to really shrink into your margins. And now maybe you're not going to be as attractive as an investment option. So that's why we've seen the NASDAQ, some of those high growth companies, suffer a little bit more than a lot of those established companies. So yes, the NASDAQ has been hurt a lot more than the S&P 500 this year, where over the last 10 years, it's been the exact opposite. The NASDAQ has been crushing it. The S&P's done really well, and NASDAQ has outperformed it. Those things have started to switch during this high interest rate environment. So again, something to monitor as the Fed changes the interest rate. How will that impact growth companies? How will it impact the S&P 500? But also the reason that we're so valuable in terms of providing a lot of diversification, right? Having the right blend of diversification in your portfolio, so you don't have to worry about those things. Having the right blend of small value and international and domestic and NASDAQ and S&P 500, having the right portfolio structure for you can be very important so that you can stay invested during this volatile time period.
I appreciate it, Sean. So that's all the questions that came in, conversations that we're having with clients. Again, a few things that we're monitoring. In the coming weeks, a lot of job earnings are being posted this week. Friday, jobs report will come in, and then next week on the 10th, we'll have the inflation rate reflective of July over July for 12 months. So any questions that come up between now and September, the first Monday of September, please reach out to Sean and I. We're here as a resource. If not, enjoy your August, and we'll see you guys in a month.
Thanks, everyone.